Hello, everyone. Welcome to the March 2nd, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by Indy Wealth. Today, we're going to get right into those hot button market issues. So let's get started. Let's start here. We had Iran. We attacked Iran over the weekend. Us and Israel sent missile strikes into Iran, and there's been a little bit of conflict since. I'm going to talk more about this from the market's perspective because I'm hearing a lot about oil jump and aggressive oil. I even saw a couple of comments about $100 oil and in the future, which is entirely possible. Don't get me wrong. But also, I want to take a little step back here. Yes, oil is up about 7% as of this morning, but that's to $71 for WTI. $71 is absolutely fine from an economic perspective. There's no constraint, no real constraint at $71. In fact, we always think kind of the median range is kind of that $60 to $80 range. So we're right in the smack dab in the middle of that. So I don't see this. Again, this is rising, and could it accelerate further from here? Absolutely. If the tensions escalate, or we get further and deeper into this, or if Iran starts directing their missiles towards other oil fields, these kinds of things, there's a lot of unknowns that can happen. So it absolutely makes sense that we saw an oil shock here a little bit this morning. But it was already quite low before. And so this exacerbation kind of brings it up into normalized ranges. We are not in extending level yet, where I would get concerned that, one of our big discussion points here has been the effect of that. Really, we've had, despite a pretty soft job market, a pretty resilient growth environment because of that K-shaped economy, where the mid to upper tier household is still spending, while the mid to lower tier household is starting to retrench a little bit, or has been retrenching a little bit because of affordability, because of a worsening job environment, these kinds of things. Well, we've had the benefit of pretty cheap oil, so therefore pretty cheap gas, which again acts as kind of a tax relief to a consumer, and especially that mid to lower tier consumer, because they got to go to work regardless of whether they, if they have a job or not, they're going to work. So they have to put gas in the gas pump, and it hasn't been a disaster zone from gas prices at this point right now. But one of my worries was a shock like this to an already, teetering economy. I wouldn't say it's fallen off a cliff by any stretch. Again, it's been pretty resilient. Growth's been pretty resilient, but that's all been with cheap oil. As oil gets more expensive, and therefore gas prices get more expensive, it does act as a tax on consumers. It acts as a tax on businesses. It acts as a tax basically on everyone except oil companies. So we have to be a little careful here. If that number goes from 70 to 75 to 80 to 85 to 90, then we're talking about more of a concern. But I think right now it's still too early to say that. I think we did lift on the unknowns. A lot of times these uncertainties and these geopolitical skirmishes can have a short-term effect, but really not a whole heck of a lot of sustainability around it. We'll see where this one goes, but right now I'm not considering oil at a place that is really damaging or worrying about the economy. Turning to number 2, we got a jobs report coming this Friday. That'll be interesting because January's was pretty strong relative to expectations. Now, again, is it massively accelerating? Are we at the areas from 21 and 22 where we were hiring everybody and there were no job openings and all that stuff? Absolutely not. No, we are in a slow growth environment. Even with the better than expected report in January, it's still relatively slow growth. It is expected to decelerate back down to that 50, 60, 70,000 job mark from the 130 we saw in January. So we're still in job growth, but a lot of people are worrying about if January was a little fluky because the numbers were weird and all that stuff. What does February show? Does February show a continuing, if you take the longer term view, a continuing worsening of the job market, or are we in reacceleration mode? So it'll be interesting to see what February's job numbers look like and how that relays into what the Fed is going to do, how that relays into just economic growth. Because again, in my opinion, especially for that mid to lower tier, jobs are incredibly important and job sentiment is extremely important. So I'm going to be paying a lot of attention to the jobs report this week to see if we are reverting back down, or if we're accelerating back up, because that could have a pretty big influence on, again, what the Fed is going to do and what the economy is going to look like in the next 3 to 4 months. Turning to a company specific, so Nvidia reported last week. If you looked at just the business and how it's doing, it was phenomenal. It was absolutely a killer report. It crushed all the numbers, blew past expectations. They're suggesting there is nothing in the way of slowdown with regard to the chips. But if you look at the stock performance, it lagged right after. And I think a lot of that comes from, I mean, again, ultra high expectations are part of it. But I think, there is fear that competition is starting to work its way into this market, whereas Nvidia has owned it basically. Now you have, other competitive offerings, and people actually, the buyers of these chips, the people that are building the data centers, the Googles, the Apples, all these of the world, the Metas, actively looking for other sources, which makes perfect sense. They should, right? I mean, you don't want to be beholden to any one particular company, so they should look for other areas. But it doesn't take away from the fact that Nvidia still owns this landscape for the most part, and it's still exploding in growth. So from the perspective of the business alone, there wasn't anything in the report that I would suggest that was an inflection point negatively. From the stock side, you can see people just have a higher degree of skepticism here in these types of names. And, again, it was the software companies, then real estate. I mean, they're just kind of flowing their way through. Where does artificial intelligence hit? How much are we going to actually spend on this versus the expectation? These kinds of things. I think there's just a little bit more worry that this can't go on forever. And it really can't, from a perspective of how much is being spent on this. There is definitely an overspend. There's no question. But we've been in overspend condition for probably about 2.5 years right now. And the companies that are leading that spend don't seem to be suggesting that they're taking their foot off the brake or off the gas anytime soon. They're certainly not slamming the brakes. And in fact, a lot of them seem to be pressing down on that accelerator pedal even further. So we'll see. This can continue for a while, but also if we start to see real economic issues where the other parts of their business aren't growing as fast, well, CapEx is a pretty quick way to reduce your cash burn that you're doing and basically say, hey, we need to be a little bit more conservative here, so we're not going to spend as much on chips as we said we were going to do. That's entirely possible. I think Nvidia is feeling a little bit of that strain right now from the investor expectation, but from just the earnings, if you just looked at it and you just look at the outlook of the company, you wouldn't see any of that in the report. Turning to number 4, the last one, we're starting to get some morning sun. So I bring my child to school every day. I drop them off. And on the way back, I am facing right where the sun is coming up. So I'm blinded on my ride back from dropping them off at school. But it's an enjoyable blinding because it means the sun is coming out. And in Minnesota, in the wintertime especially, the sun is all we have to attach to because it's still pretty cold out there. So it is nice to have, even though it is blinding on my road back. But daylight savings is just another time where it's going to be taken away from us because it's the pull forward. And so then it gets dark in the mornings for a little while again. Then it doesn't last very long, but it is just one of those things where the spring ahead is just not my favorite thing from daylight savings. I wish we got rid of it. I wish we would just deal with one particular time frame all the time. I am not a daylight savings person. I'd rather just have it consistency and go from there. But I will take the morning sun when I can get it. And today was a perfect example of that. It was very bright. It was very nice to see. So that's all we have for this week. Tune in next week where we'll have our next hot button issues. But until then, thank you very much. Take care.